Hello, fellow traders. 'Tis I, the Rumpled One, coming to you on June the 11th. The year's 2019. Let's talk trading. What is in your trading plan? Yesterday we talked about who, what, where, why, when, and how about your trading plan. And, we discussed a few other things, about the risk and money management, the method, execution, and how confidence, competence, success through repetition they build. And as usual, we reviewed money and risk management because you have to have that each and every trade, no doubt. And then we talked about a few different things. And you can see here, I put back the chart that shows the weekly um, open and gap. And you can see we still have some gaps that need to be filled. Now, we talked about method and selecting a method, something that, in my opinion, you should have statistics that show you that the method gives you an opportunity to take profit. Now, as I've explained a few times, gaps don't have to fill for you to make profit. They might fill and you make a profit. They might not fill, but you could still make a profit. It's all in your management, in the money management side. If you're up 5 pips and there's 10 more pips to go to the gap, and if you allow that trade to draw you down in the negative, then you blew your 5 pip profit. I mean, that's just something that you have to understand. Now, you have to have patience and give the trade time to mature, but once you're in profit, 5 pips, 10 pips, you need to move that stop up to break even +1. And you will experience a number of times where that break even +1 gets triggered, and then that price turns around and goes on to hit your profit target. And you will probably kick yourself. But the thing is, what you don't look at is how many times it hit your break even +1 and stopped you out, but then continued to go down, down, down. You won't remember those. Trust me, I know. You will not remember those. You will only remember the ones where you missed out. And you see, that's part of the fallacy. And what happens is that you're not keeping statistics. So a lot of times what traders will do when they look at their trades and they analyze their trades and they put they say, okay, this was a win, but they stop right there. But no, what you need to do is maybe the next day or the next couple of hours, look and see where price moved. So, for example, you move that stop loss up to break even +1. And let's just say the original stop was entry -10. Okay, so price went up to say +5. You move your stop up to +1. Then it came back down, stopped you out, and now you're mad. But then it kept going down, down, and would have triggered that entry -10. Do you keep that in your records? You probably don't. But if you did, you might then have a better appreciation of that break even +1. This is nothing I can show you. This is something you're really going to have to do for yourself. It's pretty much that simple. But that's one of the things that you probably won't find in what I call the traditional trading education, because they only look at a certain time segment. They don't project it out past the trade to see what could have happened or what would have happened. And that's the old woulda, coulda, shoulda. So if you should have done something, then do it. And then you can't say, well, I would have done it. No, you did do it. They say, well, if I hadn't have done it, I could have. See, that's when you just play those mind games. And those games will only um, work to make you a less profitable trader as opposed to a more profitable trader. So it's just something to keep in mind. Like I said, something that's not talked about. But just see, just take a look at how many times that break even plus one saved you your 10 pips or whatever your stop loss was. And right here, what do we have? We have the buy zone, right? And at the buy zone, you see we had a pivot point that was missed. Here's the pivot point sitting right in the middle of the buy zone. Not much of a bias. Price was below the weekly open. So that was like two reasons to go short, but we never had a short trigger. In fact, we just had one long trigger that paid off. And now we're right back to the weekly open cross. And you can see here, back and forth across that weekly open, just trading that weekly open here and here. You see there was profit to be made. Once again, weekly open cross, daily open cross, the buy zone. You can just trade simply, price at that horizontal line. There's no magic to it, but it's just something. If you look at the chart, you can see how many times price will go across that weekly open or the daily open. And usually, um, it's a strong move. Once it hits that weekly open and crosses, you can usually look to snag, you know, a bunch of pips, sometimes, in the dozens, sometimes in the hundreds. Now, of course, these videos are for educational purposes only, and your results may differ from mine. And you can see here we've only got 3 pairs over 100, one of them being the new beast. The old beast is only at 83. And you can see on this screen we broke out of the previous day's high, and we're back in the previous day's wick zone. On the Einstein line, you see you had a trigger there, and it was good for about 4 or 5 pips. So one of the things, depending on time of day, some price might be more volatile, say when New York opens, but right now it's lunchtime, and you can see here, there's not much movement during lunchtime in New York, it just isn't. And right now you can see here the current range is only 56 pips and the average range is 70. So we still have some gas in the tank. Range, being 50 to 59 about 20% of the time. And you can see on the 1400 chart, or 1400 hour here. Let me switch this over to H1. Let me switch. Period 1 hour. So you can see this. I like to use the 1400 candle, high low. This is a range to break out. You can see here, once again, it paid off Now that was on Euro franc. Switch back to Euro yen. But you can see here, using that as a breakout. See, for some reason, um, this candle at the 1400 hour, it just seems to work out for some breakout trades. They're usually good for, to grab a handful of pips. And so you see sometimes you get nice, sometimes right here, you get a scratch trade. Sometimes I won't go back to the well. It just depends. Here, you see, you got a short trigger, almost reversed. But so what happens is you take your money off the table and then maybe you wait. You wait out the next candle. And then you see what happens with this candle. So you can see here, made a lower high and this candle made a lower low. Price closed in the zone, failed to make a higher high, so it made a lower high, started to reverse. So here you could take that breakout, and once again, it paid off. And just looking at the high, the wick zone of the previous candle right here. High, open, close, and low. And then simple price action. Once again, you don't have to use the semaphore. You can just use the lines. And once again, looking at the hour candle, price doesn't like staying in any particular 10 pip range. It just doesn't. It almost always leaves. I mean, you can look here and you can see it. Okay, in the beginning of the day, we had 3 of them. But then after that, after we got into the Tokyo session, price didn't stay here, had to leave, didn't stay here, had to leave, didn't stay here, had to leave. And you can see that's what happens because price ranges. And when you have an average range of 70 pips, price isn't going to stay in a 10 pip box. It's just not. It has to leave. So part of your plan, part of your trading plan would be to take advantage of that. You say, I know price is going to have to range. So if this has an average range of 70 pips, and after the first 3 hours, it's still in a 10 pip block, then I know it has to leave. I'm just going to take the trade as it leaves and see what happens. So you don't have to have anything special. I mean, you can do this in your head. You go, okay, price is within. Right now, it's within between 80 and 90. But it's already ranged, 55, 56. So do you think it's going to range more? Or do you think it's going to stay within this high-low? But price is going to range, so chances are it's not going to stay inside the box where it opened. It's going to range outside that box, maybe for a pip or two, maybe for 10 or more. You don't know. That's why it's trading. So in your trading plan, what I would suggest you do is one, after the trade's over, you look over the next hour or two, or maybe even day, to see if that stop saved you. So you don't have that hindsight bias or the confirmation bias. That's number one. And then number two, just remember something real simple. Price ranges. It's not going to stay put. It's going to move from where it is. So whether you use something like the Einstein line or just the plain sweet spots gold, just remember price moves. And always remember, it's not what you trade, it's how you trade it. So let's continue the draining of the banks.